Last week, I had the privilege of attending the Mo Ibrahim Governance Weekend in Marrakesh, where the theme was Financing the Africa We Want. It was a powerful reminder that Africa is not asking for charity, but for a seat at the table, for fair treatment in global institutions, and for financial mechanisms that reflect its potential, not just its perceived risk. What struck me most were the recurring words: bias, exclusion, inertia. The global financial architecture designed generations ago is simply not fit for today's world. As we sit here, 56 developing countries are on the verge of default. 17 spend more on debt interest than on education or health. What does that tell us? That the world's financial system is protecting itself, but not the people it was meant to serve. It is no surprise that this creates anger, that it fuels polarization, disillusionment, even radicalization. And yet here, in the G20, in global capitals, we continue to debate whether to divest in development or in defense, as if these were mutually exclusive. But the truth is, there's no security without development and no development without justice. We, as liberals, believe in freedom with responsibility, in rules-based cooperation, and in the power of human dignity and innovation. That is why today's conversation matters. It is about rethinking how we structure global finance to serve people, not just preserve systems. The Friedrich Naumann Foundation is proud to support research such as the paper by Dr Aaron Thegeya on public debt, fragility, and the global financial architecture, which we'll discuss today. But we are also here to discuss, to challenge ourselves, and to help shape the reform ideas that must go from roundtables like this one to the halls of decision, or the halls of decision making, especially as South Africa prepares to host the G20 summit later this year. So thank you for being part of this effort. May today be both thought-provoking and action-oriented, because the stakes are too high for anything less. Jeremy Meggs is a media specialist with a 40-year career in television. He's our host today, facilitating the conversation. So his career ranks from television, radio, and print. He's best known as the presenter of Who Wants to Be a Millionaire? He also hosted ENCA's Lunchtime News until early 2021, when he co-founded Bold, a strategy and reputation management firm within the Brave Group. Jeremy has held senior editorial roles, including editor-in-chief in ENCA and editor of Radio 702 Eyewitness News. He has presented on SAFM and Power 98.7, where his show The Power Update won Best Current Affairs Program at the 2017 Liberty Radio Awards. That same year, he was inducted into the SA Radio Hall of Fame. And we are very pleased to have you here, Jeremy. Thank you very much.
Inga, thank you very much indeed. I get very sad when you say 40 years in the media. One confronts one's own mortality at that point. Inga, I know I speak on behalf of everyone when I say thank you so much for that beautiful fire that you've got in the corner. Because unlike our European counterparts here, we don't always handle the cold weather as well as you do. So we're very grateful for that. I had to look up what a round table was, as opposed to a panel discussion. And let me preface it by saying that because I'm in the broadcasting industry, broadcasters have one trait in common, and that is we really love the sound of our own voices. But I'm going to step back in many respects today, and I'm going to open the floor to as much conversation as possible. And it's really my fervent hope that whatever comes out of this conversation is not just trapped in that circle of dialogue and discourse, is that something actually happens as a result of that. Some new ideas are sparked, and maybe there's a call to action down the line. I hope so anyway, which is important. So I'll introduce you to my august panel members in just a moment, but maybe let's start with an introduction to the policy paper, which you have in front of you. And it underpins, I think, today's discussion. low-income countries in the debt trap. It's authored by Aaron Thegeya of Alicot Limited. He is a leading voice on sovereign debt architecture and fiscal reform in emerging markets. So Aaron, I'll give you the floor first of all, and then we'll come back and we'll seed the conversation. A very warm welcome.
Good afternoon to everyone, and so what I'm going to do is spend a few minutes giving some highlights from the policy paper before handing it back. A lot has changed since the paper was written, and I think it makes a lot of sense to discuss what has happened globally to help us set the context, right? And the key message here is the downside risks have increased significantly since the beginning of this year, right? So we've had global priorities shifting towards significantly more inward-looking foreign policy, and that has meant a number of things, right? First and foremost, we've seen a major decline in official development assistance, with major cuts, especially by the United States, and followed by European economies. And that has had quite a number of major sectoral impacts, especially within the healthcare sector, right? And here I speak more so for low-income economies, and also in particular when you look at healthcare systems in Sub-Saharan Africa, these have tended to be very, very much dependent on aid flows, right? So we've seen a 40% decline in aid flows to the health sector, and this has created, in some instances, pandemic-scale disruptions, right? Last seen during the COVID-19 pandemic, right? So this is, I think, quite serious, and it's worth keeping in mind. Second, we've got increasing global uncertainty that's being driven by trade wars, and that is creating a downward drag on economic growth. So across the board, we've seen downward revisions in economic growth projections both this year and next year. And very importantly, the uncertainty is leading to tightening financial conditions. So not only are we seeing slowing growth, we're also seeing borrowing costs increasing, right? And there are certain aspects that then become quite significant for resource intensive economies, because slowing global demand also leads to slowing demand for commodities. And especially for economies that borrow, low-income economies that borrow in foreign currency, right? Should uncertainty persist, we may see further pressure on currencies in terms of depreciation, which will only increase the debt burden, right? The debt servicing burden, right? So in the context, economies are trying to react, but the point is revenue mobilizations are gaining some traction, but the impact is quite limited. All right, so having said that, let's talk about debt fragility, right, which is still very high across developing nations. We have 9 economies as of March in debt distress. All of these are either low income or lower middle income economies, and we have 26 economies at high risk of debt distress, right? The graph that you see on your right shows you that the highest share of these fragile economies is in Sub-Saharan Africa, right? Now, one key takeaway I would like to ensure that we take is debt fragility is systematic. It exists across all geographies, and it exists across diverse economic profiles, right? So this points to a global financial architecture that is not working. It's not just that you have some certain countries that have poor institutions or you have corruption or whatnot, right? Countries that have been performing quite well, as well as countries that do have these issues, right, are all impacted by debt fragility. And why do we care, right? At the end of the day, we don't care about debt. What we care about is development, right? And the debt burden is contributing, in some instances, in a major way, towards diverting government expenditure from where it's needed, right? So we have very high gaps in terms of financing social sectors, so human capital, education, healthcare. And we also have very high gaps in terms of infrastructure investment, right? So we have some cases where interest payments exceed 20% of government revenues. I think we'll hear from our colleague from Sri Lanka that it might, in some cases, it's even significantly higher than that. And so it's not just the fact that these payments lower government expenditure from where it's needed, but these debt burdens and these debt servicing costs also have a disproportionately large impact on poor and vulnerable households, right? So if we take a more medium-term look and we look at, so where are we headed in terms of our SDGs, right? Already developing countries were way off track, right? 1/3 of countries have stalled or even regressed in terms of progress towards the SDGs. And when you add debt servicing costs on top of that, that makes the situation even more grim. Right. Now, I would just like to very briefly highlight the distribution of debt and at the same time juxtapose it with the distribution of global population, right? So the takeaway is the majority of global debt is held by high-income economies, which at the same time also constitute a very, very low share of global population. So high-income economies account for 71% of global debt, but only 16% of global population, right? Conversely, and here I will look at specifically the least developed economies, their share of global debt is less than 1%. But at the same time, they account for 9% of the global population, which is 688 million individuals, right? And one other statistic I like to always say, when you take the sum total of developing economies, the total debt amounts to about 350 billion. Within a year, the United States military spends 800 billion, right? So more than twice as much. The total debt outstanding in developing economies, right, is spent by the United States on its military alone. Okay, so these charts just kind of show you the distribution of debt at the top and the distribution of population, but I've already mentioned that. So, excuse me. What are the challenges with the global financial architecture? First and foremost, the key issue is that the financial architecture does not allow developing economies to make the long-term investments that they need to make, both in the social sectors and also in terms of physical capital, right? We've seen very many studies that say that there is an extremely high return on investment for investments in education and healthcare. In theory, these should be very low-risk investments. It's just that they take 10 to 15 years to be realized, right? But raising financing for these very critical investments is quite difficult, right? So that's, I think, the major challenge. But some aspects also contribute. Number one, external debt tends to be denominated mostly in foreign currency, and this exposes these countries to currency risks whenever shocks occur. Second, although for the least developed economies, you do have concessional debt and you do have a lot of grants that are provided. But for the concessional debt, there's very little incentive, especially for the multilaterals. I'll keep the bilateral lenders aside, but especially for the multilaterals, which have strong incentives to maintain their credit worthiness. They have, so that also means that they are very, very unwilling to renegotiate on outstanding debt, right? Then we've seen, particularly across lower middle income economies, an increase in the diversification of creditors, and specifically with the last, these debt crises that we're seeing unfold, there's a higher difficulty in terms of coordination, right? Especially because you have bondholders, and you also have China, which is not a member of the Paris Club, right? Also, I'll just mention 2 more points. First, we have poorly developed domestic markets. Many people find it surprising, but then usually domestic debt is more expensive than external debt, right? And there are many factors that contribute to this, including quality of governance, macroeconomic stability, but also just the amount of effort that's been taken to improve the depth of domestic markets. And finally, also in terms of credit ratings agencies, there's a lot of concern that has been raised about a perception premium when it comes to developing economies. All right, so I'll end by talking about some recommendations. So what should we do? First, rethinking debt sustainability frameworks so that we are able to support developing countries to borrow sustainably for the long term, right? Second, tailoring instruments to account for external shocks, right? So that would mean promoting instruments that allow countries to borrow in local currency, but then also promoting instruments that allow you to account for external shocks. So that's what we're calling state-contingent instruments, right? So if a shock occurs, perhaps your repayment obligations are lower. Third, leveraging regional development banks to originate more debt at concessional rates. We know that their capital adequacy requirements are quite conservative, and there is room for them to originate more debt. Also, supporting robust frameworks, and now this is where we come and talk about the countries themselves, right? We need better transparency in terms of debt that's being originated on behalf of citizens, and we need higher due diligence, not just by the borrowers, but also by the creditors, right? They really need to uphold their end of the bargain as well. Prioritizing domestic debt markets, I think I've already mentioned. Where we have economies that are at high risk of distress, preemptively negotiating deep discounts on that, because that allows the economies to recover more quickly and actually can make all parties better off. And finally, addressing illicit financial flows. We have about 2 to 5% of GDP that is lost to illicit financial flows. And addressing these concerns would actually lower the need to borrow quite significantly. Thank you very much.
Aaron, thank you very much indeed. Let me introduce you to the rest of the panel. First of all, standing in for the Deputy Minister of Finance today is his Chief of Staff, Jordan Griffiths. Jordan, good to have you with us. Sitting next to me here is Roshan Pereira, former Director at the Central Bank of Sri Lanka. To my far left is Christopher Mugaga, is Director of the Zimbabwe National Chamber of Commerce, and Elizabeth Sideropoulos is the Chief Executive of the South African Institute of International Affairs. So let's wade in, and if I can start, Jordan, let me come straight to you. When you look at South Africa's fiscal roadmap, what's the general sense? Are we managing risk well, or do you think we are simply in a position where we are deferring disaster? Before you answer the question, folks, I will keep a weather eye out for anybody who wants to jump in, and just put up your hand, and we've got a microphone, and I'll come straight to you as well. But over to you. You've got a mic on, right?
I've got a mic on.
Oh, good.
I don't know if I need to move with the other mic, but this will be sufficient. Great. Good afternoon, everyone, and thank you for coming, and thank you for hosting us. So, the country is I won't use the word fiscal cliff, but a big priority now, this has come through to the GNU, is to reduce the GDP to debt ratio, which is a core indicator that you track in order to assess whether your public debt levels are going to be unmanageable. Now, currently, South Africa's graph is going up, and it's been going up for over a decade. And our plan, at least, is for it to peak at about 77% and then get it down below 70%, at least by 2030. And that's a key policy directive that exists within the GNU and something that exists within National Treasury. So, for those who don't know me, my boss is the Deputy Minister of Finance, so speaking from that kind of perspective. And that is there's a lot of support for that within the officials in National Treasury and the way in which we're framing policy instruments, one of which is the development of a fiscal rule and a fiscal anchor, which is effectively a policy directive which seeks to constrain spending. It says, if you reach this point, you will then stop doing these things, which is great in theory, obviously, if you have it, but politically it must be applied in practice. So to come back to your question, Jeremy, at a commitment level, South Africa has committed towards trying to get its debt to GDP ratio down. But currently, to do that, we must be able to control government spending, which is going to require hard choices in the future, and grow the economy. You have to grow the economy, and that seems to be one of our key barriers. And we can talk a little bit more about that later. But indeed, we are very close to the edge, and we need to pull back now. We need to pull back now.
What are those hard choices that we need to make in the short term?
So we've got to look at our spending levels across various aspects of the state, and I think there's a lot of social spending which we need to critically review. Many of you would have seen the discussions about that took place, and the notion of taxing a population that's already quite taxed in the absence of sustainable growth. So, for instance, one of the choices that's being made now is deliberately investing more in infrastructure over the coming years to try and drive growth. So, infrastructure over the next 5 years, our allocations are set to increase by double digits. But this also comes with very, very intense social spending directives. I mean, many of you might be aware, you might not know, but we still pay a COVID grant. We pay a COVID grant, which is 370 Rand a month, and it costs us 44 billion Rand a year. Now, when that was introduced, it was only supposed to last for 6 months. It's now 5 years later. And the reason why it still exists is because politically it's important, because once you start handing it, it's very difficult to roll back. But we need to rethink some of the way in which we allocate grants and where they should go and to who. But we also need to get critical value out of our big social spending, out of education, out of health, where we spend some of the most amount of money but have incredibly poor outcomes, particularly in education. So there are choices that we have to make, and we have to make sure that they push us towards a growth environment where the economy grows, which generates more revenue, so you don't necessarily have to roll back too much spending.
Thank you. So, let me pick up on that word choices, if I can, and maybe there's some lessons from what has happened in Sri Lanka. Was the crisis in that country a failure of economics or of politics?
Just to give some context, Sri Lanka went into its first debt default in 2022, and I would say it cannot be attributed just to a failure of economics or politics. It's a combination of both, actually. Because when it comes to economics, the warning signs were evident for years. Sri Lanka had been running massive budget deficits, current account deficits in the external current account, and accumulating external debt with very limited capacity to repay. And I want to preface, I mean, taking on debt is not bad as long as you use it correctly. You use it to, build your capacity, your income generating capacity. Unfortunately, a lot of this debt was spent on projects which were kind of vanity projects, white elephant projects. And when the time came to have to repay these, that's when it was all a disaster. So for decades, successive governments were called to correct these imbalances through fiscal consolidation, restricting non-concessional borrowing, and allowing the currency to adjust. But unfortunately, governments, yes, they are willing to do this up to a point. And Sri Lanka has been, before the crisis, we had been in 16 IMF programs. And each IMF program, and I've done a study on that looking at the past IMF programs, there's a consistent theme: fiscal consolidation, reducing non-concessional borrowing, And during the period when we were in these programs, I mean, governments behaved. But unfortunately, because of political expediency and usually the electoral cycles, all this was rolled back and we reverted back to our old ways. And just to give you some context, the government in 2001 did a massive, there was a huge program to kind of revitalize or roll back some of this. And there was a document that was produced through it was an internal process. And there the main theme was really that the government document really said that that the public debt will overtake the size of the economy and eventually we will not be able to pay our debts. And in that document, which was in 2001, it said the single-minded priority to overcome debt crisis is to overcome the debt crisis. And in 2001, the outstanding debt was something like US dollars 891 per woman, man, woman, and child in the country. By 2023, when we actually hit the brick wall, it had increased to 4,309. So basically, it increased fivefold. We did nothing in those 2 decades. So it is an economic issue, but it's also political because the crisis was marked by lack of evidence-based policymaking. As I just told you, we borrowed, but we spent on things which did not raise the revenue or raise the capacity of the economy. And the decision-making was very centralized, and there was a breakdown of institutional checks and balances. And fiscal policy was really subordinated to the short-term electoral cycles. So Sri Lanka is really a cautionary tale about what happens when governments suppress these economic truths or take on decisions which are not, which don't look at the welfare of the entire populations, and politicize this policy making and basically reject all transparency.
So how do you find a balance then between managing the cacophony and the noise of politics with the need to act quickly in managing debt prudently and responsibly?
Yes, so I think Sri Lanka is a good example for that because from 2020, think tanks, economists kept stressing that Sri Lanka had to, the day of reckoning had come, and we had to admit that we couldn't repay our debt and go into some kind of a debt negotiations. And if we had done it in 2020, if the government was willing to admit that we couldn't repay our debts, I think the pain would have been much less. Unfortunately, governments think that something will happen. They'll be able to overcome this crisis. They'll be able to borrow because as long as governments can borrow and repay, the party goes on. It's the moment that you cannot refinance your borrowing, that's when everything collapses. And the government of the day just kept going on until that moment. So I think you have to act early because otherwise the pain becomes much more difficult.
Just a quick one because I want to come to the other panel members in a moment, but how did you know that you'd reached the day of reckoning?
So the writing was on the wall. Basically, we knew that we couldn't pay for our basic necessities. We had shortages of fuel. We couldn't import. Our importations were restricted. We couldn't, the government put in certain restrictions. So basically, it was very difficult to get fuel, very difficult to get medicines.
Christopher, let me come to you at the end of the table. Do you believe that debt has become more of a political survival tool rather than economic necessity?
Quite a very difficult question, I would say, because if you look, I think I'll try to zoom in from the country I come from, but at the same time also having a bias to a number of sub-Saharan economies. Indeed, I think debt, you can't separate it from the political discussion. My brother coming from Kenya, for example, you will know just same time last year, you know when the president of Kenya wanted to raise about $2.6 billion through tax increases, leading to protests. Neighboring Zambia, if you talk today, one of the few countries, possibly in sub-Saharan Africa, since 2020-21, experiencing a debt default. I think outside Zambia, you talk of who? Ghana and Ethiopia. Possibly now you've got Chad on that. Then trying to come back to Zim, the strange part of Zimbabwe, I think, is one of the few countries where you see the gross tax to revenue is usuriously so unhealthy and high because of complete absence of official development assistance. I think you appreciate the standoff between Harare and Brussels, Harare and Washington at the height of Mugabe's rule. So it's a difficult thing. But it becomes a political worrisome issue when there's no transparency, especially on how you manage a budget. Talk of a country like Zimbabwe, where you know the Public Finance Management Act, a very common piece of legislation within the fiscal framework. A treasury boss, a minister of finance, is expected to report to the parliament twice a year. You can't procure new debt without ratification or the parliamentarians allowing for it. But in my country, I think you'll see it has not been common like that. It's a case of cheap whips. Most African parliaments, if ANC is in power, if ZANU-PF is in power, if it's the same with Chama Chama Pinduza in Tanzania, the political power, if it rests with a ruling party, it dictates the pace of how debt is procured. And unfortunately, for an average citizen, especially in Africa, they don't even know at what rate their governments are procuring debt. It's quite a very sad thing. Some can try to limit it to say, no, debt is also economic. Yes, the financial architecture is quite very unfair, possibly, to poor economies. If you listen to my brother Thegeya's presentation, 76% of debt in the hands of the developed world. But then, if you look at a country like Zimbabwe, I'll talk of external debt. If you look at the stock of external debt as I'm talking to you, we are looking at a small figure, but it's a small economy also, remember. 12.3 billion. But of the 12.3 billion, Zimbabwe, interestingly, doesn't owe a dime from International Monetary Fund, about 1.5 billion owed to World Bank, possibly just below 700 million from African Development Bank. The Paris creditors, 400-something million. But Zimbabwe, as we speak, cannot secure any line of credit. But this has given room to one emerging superpower, I'll call it, China. China has managed to put its nose. Some can call it a neocolonialism, some can call it a new world order, but China Development Bank is pushing projects where Africa is procuring debt at a rate which has never been realized before. And obviously it will have its own implications, both politically and on sustainability issue. We need leaders, firstly, who are accountable to their people. If there's no accountability, the core relationship with procuring debt without anyone raising queries is an issue. Caliber of our legislators, this is not unique to one country, but most of our legislators, either you are in the NC, or in EFF, it's ZANU-PF, it's opposition, there's a challenge. I think the quality of our legislators is so shocking that an average legislator does not know even the debt framework and policies required, which is a political issue, as you're asking. Because once you have a weaker politician who doesn't understand the economics of debt, it's a sustainability argument, which is quite very sad. So in summary, I can say debt, you can't exonerate it from a political discourse, but at the same time, it is underlying tone of an economic challenge.
Just a quick follow-up on that. You spoke about transparency, which I think has become a very overtraded word. How do you either improve or enforce transparency in that respect, so there is adherence to the principles that you've just outlined?
The challenge with the interpretation of transparency is, what does transparency mean to an African leader who believes in absolute power? It's different, possibly, from transparency in a democracy. The more closed the political space is, the less transparency you can expect. I think it's quite common in most African states. Let me give an example. As I'm talking to you right now, the Zimbabwe government, through the Treasury, it has assumed debt of about 2.8 billion from the central bank. Think of South African Reserve Bank and its operations every day. But through mispricing of exchange rate or exchange rate mismanagement, government will enter in carrying debt. Some of the players, your SA, South African Airways and all these, they are owned by the government because they couldn't push money out of the economy. So what does that mean then? It's a debt. That debt has been taken in the books of government. So when you talk of external debt, as I'm telling you, of 12.3, 12.4 billion Zimbabwe, that debt includes what is assumed from central bank. So the issue is on the caliber of legislators. Do they understand their mandate to close the economies? The more closed the economies are, the higher the chances of even incurring debt without anyone picking it. Lastly, but also, I think there is need for a remodeling of the mandate of the Bretton Woods institutions. I don't think the IMF, the World Bank of 20 years ago, can still talk about a tranche of conditionalities it used to talk of before lending. Because today, before you lay out the tranche of conditionalities, which sometimes you lose democracy, and all, China will be knocking on the doorsteps. With USA closing the door to the world, what is doing China? China is using Africa and other Asian economies to push their products, and in the process also funding projects without even requiring transparency. So it's very important for us to understand the global architecture regarding IMF and World Bank. Otherwise, count from today, 10 years down the line, no one will care what IMF thinks or World Bank thinks about these economies you're dealing with.
Why does the world keep misdiagnosing, if you agree with that assertion, the debt crisis? Is it because it sees economies on this continent more as marginal rather than strategic?
I do at some point want to sort of elaborate a little bit on the transparency point, but perhaps I can do that.
I thought you might, yeah.
I can do that a little later. But I mean, I think if you look at the figures that are in a really excellent paper, Aaron, on debt and the comparison between advanced economies and developing economies and Sub-Saharan Africa, indeed the African debt is not systemically problematic. It's not going to do what we were worried was going to happen in 2008. For example, when the crisis hit, really, it was as a friend of mine calls it, he says it was a North Atlantic financial crisis. So the size and the volume is important. It's not disruptive at one level, but I would argue there are underlying issues here which are not necessarily always articulated or always front of mind that actually can pose some systemic threat. And some of these relate to the fact that we talk often about where debt is held, and debt is, it's the bilaterals, it's the big multilaterals, the IFIs, it's private creditors, but there's also a group of African banks, for example, regional and regional finance institutions on the continent that are also important players as multilaterals. It's called the multilaterals. And they, over the very recent past, have in fact been reclassified not to qualify as MDBs. And so all of the perks that go with being an MDB if you're a creditor. And one of them is the Trade and Development Bank, another one is the Afrexim Bank, that are designated as commercial banks by the IFIs. And so they are expected to take haircuts rather than trying to, not have their debt commitment touched. The problem here, and that's what the point I want to make about systemic, is that they were among the first banks to provide assistance to African countries that were in debt distress. But now that the IMF is reclassifying them, they don't qualify. But what they have done in the interim is taken out insurance with northern institutions, which if countries default on that particular debt, does pose a systemic risk to some of these big insurance institutions in the north, in the UK and the US. So there is a systemic element to it, but I don't think it's necessarily well articulated or actually factored in. So that's the one thing. The other thing in terms of misdiagnosis is absolutely right, and I think it's also in your paper, it's some of the instruments we have created over the last couple of years is to deal with the debt as if it's a liquidity problem rather than a solvency problem. And of course, sometimes a liquidity problem, if you don't deal with it early enough, will end up being a solvency problem anyway. And so some of the discussions that are taking place, particularly in the G20, and this is obviously something that South Africa has also put on the agenda in its presidency. It's been on the G20 agenda since COVID, since 2020, and the introduction of the debt service suspension initiative, is to actually explore some of the, and there are a number of proposals on the table around how you might deal with liquidity. If it's a liquidity issue, how do you provide bridging finance? If it's a solvency issue, how you really either have to deal with severe haircuts or look at state contingency contingent debt arrangements, or look at the bigger elephant in the room, which is how you deal with the international financial architecture, certainly in the longer term. And the other point, of course, in terms of misdiagnosis, is that the debt now, and I think it's been alluded to, is very different from, say, the debt we were dealing with in the 1990s and the early 2000s. The Paris Club then had pretty much had a monopoly on power at all levels. Now, it's not, they don't have the monopoly on power. They have to bring guys in. And the Chinese are not very happy to come into a club. They're never happy to go into a club where they haven't actually made the rules or contributed to the rules. So you have the Chinese. You don't only have the Chinese, of course. You have Gulf states. You have India. So you have a whole bunch of new actors, new players, new financiers who are bilateral. You obviously continue to have your multilaterals. And then, of course, you have the private creditors who tend to get away scot-free. They did that in the European crisis as well. What do? You privatize the profits, you socialize the loss. So that's another dimension of it. And then, lastly, and I'll stop there, is the question that you posed about the politics is so fundamental to all of this. The fact is that everything is about politics. We have so many, I think, very specific proposals around how we deal with the debt problem now. There are lots of technical initiatives. Some of them are better than others. Some of them address a particular issue. They're particularly niche, but they can all be utilized. The challenge here is, how do we move it from that technical debate to identifying sort of milestones and what the political constraints might be in order to actually get some of these proposals onto the table in a meaningful way so we can actually drive change.
Doesn't want to be part of a process when they can't make the rules. Reminds me of someone else, but we don't need to go down that way. Elizabeth, I just want to close the loop on your thoughts on transparency. Then I'm very happy to recognize the room if anyone wants to make a contribution, and then we'll pivot into something else. But before you lose that thought,
yeah. So, on transparency, absolutely. A lot of the points you made in terms of what we do domestically is so important. There is also part of the reason in some, at least in more democratic countries, where it may not be as transparent, is also some of the rules around contracts. So there are particular provisions in the contractual arrangements that prohibit revealing the details of the debt negotiations. And one of the, so there is, it's not to undermine, I think, the point that you make, where you need strong domestic governance, public financial management systems. It's the one thing. The second thing that you also said, which was so critically important, is, are parliamentarians in a position to ensure that accountability? And relatedly, if you do have a situation where you say, legislate that any debt negotiations have to go public once they've been completed, so that you can you know exactly what they've been signed. Are the parliamentarians in a position to actually properly scrutinize? Because these can be very technical negotiations. So that's the other thing. But the point here is that whether we're talking about China or we talk or the new donors, there is also an element where maybe African states and other developing states who are borrowing money should make a real push in a unified way for greater debt contractual transparency. It's not an easy thing. It's not going to. It's politically fraught. But that might be, one of the things that I know you want to get out of this discussion is, are there some concrete ways in which we can advocate for particular things? That's one that's critical, because debt is not bad, debt is good, but we need to make sure that it's deployed properly and that we're able to pay it back.
Anybody in the room want to add anything? Do I see anybody's hand, or I'm going to move on? So over there, do we have a microphone for the gentleman?
I'm from the German Embassy, Head of Cooperation. Thanks very much to the Friedrich Naumann Foundation for the invitation and for this very interesting introduction into the discussion and the paper. I just have one question concerning interest rates. I think the subject was touched upon, but can you say something about the role interest rates for developing countries play in that role? Why are they so high as they are? Is there a problem or a bias in that? And do maybe rating agencies play a role? So is there an unfair rating, for example? So that's why developing countries pay more taxes than others, and that in turn leads to higher payments, and that may fuel this trap that you discussed. And lastly, one more question, if I may. Okay. What is the situation? I heard you talked about the situation of South Africa, but I would say it's not in that debt trap position that we talked to, or are we already there? That would be one more question.
So as far as interest rates are concerned, I think I would distinguish between domestic debt and external. And as I mentioned, interest rates for domestic debt tend to be higher, right? Breaking down the domestic interest rates, there's the real portion, and then there's also the inflation aspect of it, right? And that second part is directly related to macroeconomic policy, monetary policy, right? So if you don't have strong institutions and you don't have properly executed monetary policy, you'll tend to have high domestic inflation rates, which will feed into the local interest rates as well, right? Second is just the depth of domestic markets. If you don't have as much liquidity and as much trade, and you don't have developed secondary markets, then you will also tend to have debt that does not have as much price discovery. And so that will also tend to contribute towards having higher domestic interest rates. When we look at external debt as well, this also impacts investors that want to purchase local currency debt, right? Although that's typically you won't have as much of that happening, but I think it's a bit conflicted, right? So on the one hand, you'll have many authorities from developing economies saying that yes, there is a perception premium, and I'll give you a small example. When you look at Asian economies, when you look at African economies, and you look at the history of defaults, right? I think you can probably sum all the defaults that have occurred and look at one country in Latin America, Argentina, that has defaulted multiple times, but still has a better rating today than most of these economies, right? So that's, I think, one aspect that challenges the view around, whether or not there's fairness in terms of credit ratings. But then at the same time, there's a lot of opposing views and a lot of work that has said that that premium is explained by the quality of institutions, corruption, and so on. So it really depends on what side you take.
Thank you. Ma'am, I'll come to you now. We just need to finish excuse me, Jordan, I'll come to you just on the South African question, and then Roshan, you had a question. You wanted to add something to it. Let's go there first. Sure. Yeah.
So, no, South Africa is not in the debt trap by any means. But, there is a moment when you need to start making the relevant cutbacks in order to wind back your debt ratios. We have a budget of 2.2 trillion rand, 400 billion is interest payments on public debt. So 20 cents out of every 1 rand you spend goes towards public debt payments. So 400 billion towards public interest, towards interest, another 800 billion on the public wage bill, that's 1.2 trillion. 300, 400 billion on grants, 1.5 trillion. So you got 700 billion to work with there, a few hundred billion on education and health, and you're left with quite a small amount there to get to that remaining 2.2 trillion to actually invest in everything else. So this is why growth is really important. And I mean, you mentioned interest rates and inflation, also political, right? Which is that, government's only got so many tools in its toolbox when it comes to trying to, shape aspects of the economy. The Reserve Bank, important to be an independent institution in South Africa, going through a very interesting phase now. Inflation is at 3%, has been for a while. So inflation is low. It's historically quite low, and it's staying there. Reserve Bank governor has come out and said he wants to keep it there, right? And he's lowering interest rates, right? This is also an interesting play, because you want to keep inflation down, you want to control spending, you generally increase interest rates so that people don't spend. So there's always this balancing act, and that's why also the independence of these financial institutions is very important. So also worth watching in the US as well, how you see Trump often attack the Federal Reserve, Colin Powell. Lower the interest rates, lower the interest rates, lower the interest rates, because inflation's down. You want them to, these are all interplaying mixes, and you really don't want politics in that place. But South Africa is not in a debt trap, and we are going into interesting fiscal and monetary policy territory, the interplay between the two, which is going to be great to watch. And if we can keep inflation down, then everything else potentially can also, public wage bill, all these things we can try and now, no more inflationary increases, this big, above inflationary increases.
Yeah, just a quick thing on your risk on interest rates. So I think when a country is seen as high risk, creditors require a higher risk premium, which then makes it, of course, harder for those countries to service that debt. So there's a vicious cycle. And typically sovereign ratings, if you look at, I think a study was done in Sri Lanka, where they looked at sovereign ratings and its correlation with various governance indicators and corruption indicators, and there's a high correlation. So if countries are perceived to be have poor governance or high corruption, these risk premiums increase. So what Sri Lanka did actually in this last debt negotiation is there was a think tank that developed something called the governance-linked bond, where the premium is linked to better governance. It now forms a very small part of the debt stock, but I think it's a way forward, where then you force countries, and there are certain indicators, if the country performs on those or achieves those or maintains those governance indicators, the risk premium, the creditors are willing to reduce the risk premium by a certain percentage. So in Sri Lanka, it was something like 75 basis points, which is quite significant. So I think these are some tools that can be used in countries to bring it down, but also I think sovereign rating agencies also need to see whether, and I think your point, is this the only indicator to, what else should you relate sovereign rating to? I think that is a very non-transparent system. I've studied that before. How do sovereign ratings actually do their rating? But we found a very strong correlation between the two. Thank you.
My question, I think, is for Dr. Aaron, Elizabeth. We have seen over the recent years that debt composition landscape within developing economies have changed from Paris Club to more private creditors. And we have seen also that most developing economies, they're still servicing their COVID-19 spending, So my question is around MTPs as well as DFIs, right? To say that currently we know that there are 4 countries that have defaulted the IMF, and where the IMF has stipulated that, any other sovereign that have lended to Zambia, Ghana, Ethiopia, and Mali should, give them grace period. So what measures, because I work for one of the DFIs in the country, and I'm writing a paper on the causal factors of public debt, as in terms of saying what measures can DFIs, your development finance institution, can put into place in order to reduce the debt trap of these African countries, because your MTPs, your DFIs, they have more of a development cap than your commercial banks. So what measures can, MTPs, DFIs, what measures that they can put in place while assisting, these developing countries who are facing debt trap while making profit? Because if inflation is high, it will then have an impact on inflation, on interest rate, and we all know that vicious cycle. Thanks.
I think first and foremost, so there's countries that have unsustainable debt and are in distress, and there are countries that are highly fragile and could potentially go into debt distress, right? I think overall, particularly around DFIs, increasing the envelope of concessional debt is extremely important, right? Low interest debt, particularly when you're talking about countries that have super constrained fiscal space, is extremely important. To the extent possible, and this is for low-income countries specifically that are already in debt distress, I think offering grants as well, and also renegotiating, right? So we've seen the very, very prolonged processes that are starting to yield results, but it's taken a very long time, right?
The system is such that you don't want to enter, if you think you can still get away with it, you don't want to enter into debt negotiations, because particularly if you're a country that has a credit rating, your credit rating is affected. That was one of the things that was also very apparent with the DSSI, the initial one that preceded the common framework in 2020-21, which was that, I don't know, there were over 70 countries that could qualify, and I don't know, about 40 or 43 or something actually applied because they were concerned about how the market, because in effect, would respond. I think it's useful to maybe break that up into how one deals with LDCs, LICs, and MICs. Of course, LDCs have to rely significantly either on ODA in the form of grants from or grants from DFIs, and really, what the point that is important to make there is all of these concessional finance windows that the World Bank has, the African Development Bank this year, it's the African Development Fund, ADF, yeah. African Development Fund that people have to commit to, so I think both with the African Development Bank's fund and with the World Bank, I mean, for every $1 that a country donates, you can leverage up to 4 or 5 or something, if I'm not mistaken. And so being able to build up the capacity of MDBs to provide both grant and concessional finance to different categories of countries is very important. And that's been a lot of the debate in the multilateral development circles and in the and what the G20 finance track has been pushing. Really, if we're going to go from billions to trillions, we are saying the private sector has a role to play, but it hasn't yet come to the party. And I think to think that it will come to the party in the volumes that we want it to, is not going to happen. So let's see what we can really do with MDBs. One thing about the credit rating and interest rates, there's an interesting study done 2 years ago, I think 2023, by the UNDP, that found that I think it was 74, so African countries were paying $74 billion more when they were borrowing because of the particular credit rating they were getting. Some of it relates to institutional governance and so on and the perception of corruption. But again, and it's a point you've also made, the number of African countries that have defaulted is very small. They will honor their debt obligations to foreigners, and they will not honor their their service obligations to their citizens. That's what the story is all about. But we still get penalized.
Thank you, moderator. I think there's one elephant in the room which most people are not willing to face. Sometimes we scratch the surface regarding the debt, the politics of debt within Africa. What do I mean by that? At one point I looked at the statistics. If you look at trade, Africa, China, value of trade, as I'm talking to you, possibly somewhere almost close to 285 to 86 billion US dollars in terms of value. Of that trade, if you look at Africa as it exports that value to China, only about 9 African countries constitute almost 85% of that value concentration. So the structure of our economies, they are also a driver of the debt trip we are talking about. Before you look at the housekeeping issues to do with which sector or what, we are still down on the value chain. That's one issue. You can't talk debt without looking at the whole economic structure from a value chain of production. We are still trapped on the primary side of the economy. So the capacity per unit, if I say your capacity per value per unit to service debt when you are producing raw materials, you look at South Africa, almost maybe 13% total exports in the whole basket of all Africa to China. You look at DRC, maybe second, then Angola. If you look at those economies, you can guess why. It's commodities, it's oil, so it's one trap which we have. Was DREP, it's a reflection, debt is a reflection of the fundamental economic structure which we have. There's an interesting question, my brother from Deputy Minister's office. Yes, you spoke about South Africa not being under pressure. But when I looked at numbers, under Thabo Mbeki, if you look at the debt to GDP, you'll be shocked that around 2007-8, it was around 27%. Today you're looking at 76%. There is a crisis. There is a crisis. And a fifth of, like you're saying, revenue going to debt service payment. It shows unsustainable debt position. I am quite afraid on that. And lastly, maybe on interest rates. Most economies, if I talk about where I come from, the principal debt is not an issue to Bretton Woods. It's the penalties, it's the interest. On average, if you look both, I gave you numbers. If you look at the bilateral creditors, Zimbabwe, you're looking at somewhere just northwards of 6.5 billion, of which almost 80% of that is penalties and interest payments. You look at the multilateral, it's the same language. So I think, remember I said, the IMF of today, if you compare it with the one of 20 years ago, maybe the whole standoff between Washington and Pretoria on G20, it could also be a fight on multilateralism. To say, you can't continue having Bretton Woods dictating pace of which economic policies make sense. The world has shifted, it has moved. Africa, it has to wake up. If cobalt, if lithium, if the electric vehicle industry from predictions is to be valued at almost 50 trillion by 2050, surely Africa should wake up. I think we are not pushing our leaders enough to say debt is a reflection of our incapacity more than all these cosmetic arguments. We continue opposing on that. That's my thinking.
I refer to your second recommendation around the use of state-contingent debt instruments. And I wondered, I hoped you might expand more on that, but in particular, I wonder if you envision something like debt standstill clauses. And here, of course, debt standstill clauses. And I think Elizabeth foreshadowed this, right, by referencing the DSSI and the common framework currently. But not only if you envisioned it, but what is the value of incorporating these kinds of instruments? Not only what is the value, but what is then the consequent risk, both in terms of default, but also risk in terms of exposure to market volatility, which I think you recognize. Thank you.
Thanks. As the mic is going, perhaps I'll just address this. Very interesting question. I think there's two dimensions, right? There's the aspect of helping the country manage its debt sustainability and also manage its ability to handle shocks. And then on the other hand, there's what those contingency clauses would mean in terms of the cost of borrowing, right? So on the one hand, I think you would expect that if you add state contingency, then ex ante, you might also expect that markets would take that into account, and perhaps the cost of borrowing may actually go up, right? So that I think is the most fundamental risk, right? But the reason I think that state contingent clauses are particularly useful is because whenever a debt crisis occurs, the costs fall disproportionately on low-income households, right? So there is value in lowering the probability of a crisis occurring by virtue of having these state contingent clauses, right? Because even if ex ante the cost of borrowing is higher, but an economy is able to service its debt, albeit at a higher cost, then we're also limiting, or at least making it less likely that we will have a crisis that disproportionately impacts low-income households. So that's at least the perspective that I take, even though on balance, it really shouldn't affect the ability in terms of cost ex ante, but the outcomes, I think, become different.
So I just talked about the governance-linked bond, which is a contingent debt instrument, but we also have something called the macro-linked bond. And the creditors insisted on that. And it was very clever of them, because basically what the macro-linked bond does is if Sri Lanka's growth underperformed, we would have to pay less in terms of the haircuts would have been higher and our payments would have been reduced. And if, of course, conversely, if we perform better, we would have a lower haircut. So what happened was really, and these are the macro-linked bonds were based on the DSA, the IMF's debt sustainability analysis, which was done pre-crisis, right? It was in 2022. The final negotiations ended in 2024. The restructuring negotiations ended in 2024. The situation, or the economy in 2022 was very weak. So, and the expectation of how Sri Lanka was going to grow also was an underestimate. Sri Lanka performed much better than that. So by 2024, we were doing much better than what was under the DSA. So ultimately, actually, Sri Lanka is going to be paying more to the creditors under this macro-linked bond. So it can work both ways. I think it's very important to negotiate on the underlying, the basis of the calculation of these macro-linked bonds. Just an experience from Sri Lanka.
Quick comment and a quick question. Dr. Mungaga mentioned, I think, trade and the issue of local value addition. Just to highlight that what we're trying to do from the side of the European Union with our global gateway strategy is to provide professional loans mixed with grants for sustainable infrastructure projects that really focus also on local value addition. So that's of course absolutely crucial. The question would go into the direction of debt relief or debt forgiveness. I think that's some big rounds 25 years ago. Does that play any role today? In what circumstances? I guess mainly for LDCs. What are the considerations? Which could be the cases where debt relief, debt forgiveness could make all parties better off? Thanks.
I don't want to tackle it from a sort of academic economics perspective, but we've had some interesting proposals on sort of debt swapping as it relates to South Africa's green assets. So, it's quite interesting because there are, institutions and sort of, I suppose, what you call the middlemen who are coming and saying, you've got the Kruger National Park, you've got the wildlife that exists in the Kruger National Park, you've got Table Mountain, you've got these these massive green assets, but they don't reflect on your country's asset book to a degree, right? They don't get used as a tool or as a mechanism in which you can, trade your debt against them or be used in these kind of deals. So, I mean, I'm not going to talk on the idea of debt forgiveness as related to South Africa and this, but leveraging those kind of natural assets, particularly for the rest of the continent, could be quite useful, particularly if they're accessing debt from yourselves in the Nordic states, which are love investing in green-focused instruments by and large. So this is one way in which you can at least manage debt towards a country's advantage, as opposed to, and I know we've taken a few knocks, but the Chinese model is often a result of, we're going to loan you debt. If you default, we may have to take ownership of your port, or of a particular. We are going to attach state infrastructure to this debt, and if you default on it, we will then take ownership or majority stake in it. So these are things that are the kind of traps that one must be aware of. So yeah, I think there's ways in which you structure public debt where you can at least be quite creative, and you need to kind of think out the box in terms of the assets that you have in your country and how you trade them or put them to market. Along with obviously your macroeconomic, you can't be a weak, all these kind of things. No one's going to forgive debt if they know that your politics is terrible. But that's maybe a nice example to think about and take with you.
So just to make sure I've got this right, for my headline tomorrow, government considers Table Mountain as okay, and you won't be working in the office much longer.
As far as debt forgiveness is concerned, I think there's one aspect that I think requires more research, right? Because it's not necessarily the case that debt forgiveness makes one party worse off and the other party better off, right? And in this particular aspect, I wouldn't even call it forgiveness, I'd call it cancellation. And forgiveness implies something, right? But there are certain instances where if you cancel debt and you do so earlier, then the chances of repayment, so this is a partial cancellation, then the chances of repayment actually increase because you improve the macroeconomic fundamentals of that economy, right? So instead of spending so much on servicing, you sort of underpin growth, right? And that will eventually make the creditors better off than prolonging, a country's state in crisis, or having a very minimal haircut, which then 5 years later results in another crisis, and so on and so forth. And each time, the pie keeps shrinking. Right, so I think more research needs to go into that, because I don't think cancellation necessarily means one party is worse off. You actually could make both parties better off. The second point was maybe somewhat related, but so issues around converting debt. So this is more around swaps, so debt for development swaps, in terms of, yes, we will cancel some debt, and perhaps whatever relief is obtained then goes to climate adaptation or whatever other critical development objectives a country has.
And relatedly, of course, there is that initiative which was begun by the Prime Minister of Barbados, Mia Motley, around the Bridgetown Initiative, which now in all new borrowing negotiations includes a standstill clause for natural disasters and things like that, which are so critical, particularly for small island developing states. So that's the one thing. I wanted to, and I absolutely agree with you on the debt cancellation. There was a study done, but I cannot remember the statistics, and I'll blame it on getting on in age. But apparently, while MDBs do not have to take any haircuts, they're not part of the restructuring because they are the superior beings in the financial world. But I remember somebody making the point in a conference on this topic that, in fact, if they did take if they did take some, if they were part of the restructuring, I mean, not, you know, not everything, but if they were a contributor to the restructuring, it would actually service them better to take the cut and then be able to, you know, the amount of money that it costs them to take a cut versus the amount of money they're actually losing by having to, that the debt is not being served or is defaulted, etc., etc. Actually, it would be better for them to be part of the restructuring arrangement than not, but that's a highly politicized political issue. I mean, you know, I don't think the European Union itself would be very happy to see the World Bank being part of that arrangement and so on. But I mean, that's the point. Last thing I wanted to say about your point about Jordan, about natural capital accounting, which is something that the African Development Bank has done some really interesting work on. In fact, they launched a report at COP29 last year, was that COP29, around natural capital accounting and how if countries were factoring that into their national accounts, how much actually they would be able to leverage and how that would change the debt situation. And that also, in a way, creates an incentive, particularly when you're talking about animals and flora and fauna, to actually retain it, so protect it. So the biodiversity element of it, yeah.
There are conditions you have to meet for you to be qualified as such. It's not a walk in the park where you walk up and say, can you forgive because the debt is here. If you look at the matrix, I think if my memory serves me well, you're looking at, it has to be proven that this debt is what? Unsustainable. You look at debt to export ratio, I think almost 150%. You look at debt to government revenue, I guess it's around 250%. So to find economies in that space, this would then leave us to vindicate an issue that poor resource management could be the reason for unsustainable debt. You come from EU. If you look at the partnership agreements with Africa, for example, possibly you will see, without being politically biased, I think Africa is the biggest loser, maybe because our trade experts are not smart enough to negotiate on that. I gave you an example of China. 27 countries right now in Africa, which are considered low developed countries, 98% of their products they can sell to China for free, but are they benefiting? No. Same to EU, there's EPA agreements, as you know, economic partnership. Most of our economies, including South Africa possibly, we seem to cry the same. So I don't think the issue is on the forgiveness only. It's the structural challenge of how you utilize every dollar you generate. The politics of being accountable. Most of African economies, the issue is whose interest does it serve? If there's a GNU in South Africa, when politicians contest to say of the 34-member cabinet in South Africa, how many, I was talking to my DA brother there also, I think you remember, they've got 6 seats in DA, but he's so convinced they should be having 11, isn't it? If they were to become 11, it means the NC also feels they are too big that they need extra 5. Before you know it, it's a bloated cabinet. So it's a lot of issues, but you have to satisfy those 3 metrics. And sustainability, debt to export ratio 150%, debt to government revenue 250. I don't think you can easily come across economies which are moving in that space. So there's a lot.
Thank you. Ma'am.
Is this okay? I don't know, but I hope you can hear me. Hello, everybody. This is Anandya Manu here. I work in leadership, development, strategy, and succession. And I want to come back to Inga's opening statement. She spoke about how do we imagine global finance to be restructured to serve people. And I want to come back to that because that's what I work in. And in leadership, we have something we call a storyline, which is to distill, it's an allegory you use to distill complex concepts such that it's accessible. So the storyline I'd like to use for this round table is imagine that all the smart aunties and uncles are speaking about the reality that we're in debt, okay? And there's a lot of complex issues that are being put on the table. I'd like to bring in the angle, I guess, of, and a future focus to some degree, around the demographic youth bulge. We all know that Africa is getting younger, okay? Whereas the global north is aging, Our average age by the year, I think AU says by the year 2063 is going to be between 15 and 18. Within the next 10 years, we're going to be on average 22 years old. And so coming back to my allegory or storyline, in this conversation that the adults are having and are agreeing that this continent is indebted, the thing that lands in my mind is, okay, well, if on average many nations are going to inherit debt, in 10 years' time, the young people who possibly are not participating in this discussion, in the framing of it, even in the writing, what do you hope they have in hand? So indeed, it's a demographic dividend. So what investment can be made right now so that there is a return in 10, 15, 20, 30 years' time, versus it being a demographic bomb, as the West tends to think about us. We're going to collapse as Africa because we're going to be so young. So what do we need to be thinking about investing in and doing, even if whether from a systemic perspective, but also from a demand side as nations, you know, to ensure that we're investing in a way that we will yield an outcome regarding this debt trap that doesn't feel overwhelming.
So, I mean, that's a great question, and I think that covers broadly the theme. Firstly, you can't continuously discuss debt restructuring and trying to manage payments if you don't at the heart achieve growth in your country. You can talk at a high academic level about debt and its impact, but if a country's access debt, it's access on the basis that they are going to generate revenue in the future, taxes, as a result of growing the economy, so that they're going to be able to pay off that debt. That's what they need to be able to do. And so I can speak to the South African context in particular, which is we take where we are right now. We forecast, and this gets adjusted, but we forecast to grow our economy by I think 1% in the next year. It was 1.2, keeps getting revised. The first quarter of this year, growth was 0.1%. So we've got 3 quarters to try and make up close to 1%. Argentina, I think, released numbers that they had 8% economic growth. Now, for a country of our, nature, size, we need to be up at 3-5%. We need to be, everyone knows this. It's the Americans that can grow at 1 or 2% because the economy is so big. So when you grow at that percentage and your economy is worth trillions of dollars, it makes a massive difference. So in South Africa right now, we have got to get the economy moving, kick-started in a massive way, so that the future generations don't inherit the debt trap, so that our debt to GDP comes down, and we don't spend a large amount of our public finances on paying debt servicing costs. There are a few key areas that we are focusing on, and they're worth highlighting. One is particularly transport. So Transnet, as a state institution, is probably holding back whole percentage points of GDP growth. So when I say that we need to grow by 1 percentage point, Transnet's inability is holding back an entire 1 or 2% of growth due to its inability to move goods. Transnet's freight tonnage has decreased by 1/3 since pre-COVID. Now I take a moment there. That is the process of transporting raw materials to the ports. It's decreased by 1/3. It makes 0 cents. It should never it should only increase. If you think about things going on the trains to get export, it should always be going up relentlessly. It's gone all the way down. So where have those goods gone? They've gone onto the roads, they're in trucks. Massive issue. Obviously, the other issue is that our ports, Durban Port, Cape Town Port, are considered to be some of the worst in the world by the World Bank Index. The ports are also run by Transnet. Okay? So Transnet is this like supranational state entity which is dysfunctional on the rail, freight rail, not that great on passenger, that's PRASA, apologies, and terrible on the ports. So we need to try and get aspects of Transnet concessions into private hands. Right? That's one aspect that we're thinking about. Energy is another huge issue in our country, right? Energy costs are rising, so then there's focus on that with Operation OV. Break up Eskom distribution generation, and transmission, different companies. Competitive energy market, keep energy prices down. That also creates a whole bunch of other spin-off effects. So that's another great space. Digital comms and that area, Minister Sadi Malatsi, he's doing a lot of great work in trying to get the price of data down and get access to technology. All of these things are relatively long-term, but will ideally generate the growth that we need. But that is the challenge, long-term. We're in for short-term pain. We're in for short-term pain unless we can move quicker on these big ticket items, at least in the South African context. And that is critically one of our challenges to take forward. So, I mean, those are some of the key things that I leave you with at a high level, to say, like, these are real barriers to growth. Transportation, energy, the ports, and how we transport goods. And if we can invest primarily in unlocking those sectors, it'll make a massive difference for us in our economy at a very high level. But you know, it's still very, very long term. You've got to be in for pain. And of course, to conclude, you know, when we plan the budget, we plan the budget on a forecast of growth. So you say, okay, we hope it's going to be at 1.5%. Then after the first quarter, you revise it. But that growth also influences your tax revenue, because your margins are so small. You've got a plan with the intention of generating revenue so you can cover your costs. And that's when we start borrowing. If we have the public, you know, so you forecast wrong ahead, you get over-optimistic, which National Treasury has been accused of doing and has done previously, over-forecast. And then you've got to borrow more. And that draft goes higher and higher. We've got to stop that. We've got to stop that. We've got to make very, very strong cuts. I think public sector, wage bill, 800 billion rand. 800 billion rand. Budget is 2.2 trillion. So public sector wage bill is almost half of the budget. Attrition rate in the public sector is 10%. So if you let everyone retire, you didn't hire anyone, you save 80 billion rand. That's 2 percentage points VAT. That's the equivalent figure. So, you know, these are discussions that were had when the VAT funds were happening. Some of them weren't one. That gives you an idea of where cuts can come from.
So debt is an intergenerational issue. And I'm just going to be very quick on this. And politicians basically would rather take on debt rather than tax their current population, because that is obviously politically a suicide. And that's what happens. So how do you prevent governments from taking on more debt, which they don't necessarily want to pay off because they think they can keep borrowing and repaying, and let it be handled by, you know, future generations. So I think there you have to have very good debt sustainability analysis. You have to have very good risk analysis of why you are borrowing. And I think what you said, you have to make sure that they are spent on things that would create capacity in the future and decent jobs for the future, rather than support your current population. So I'll just stop with that.
Okay. Aaron?
As far as youth dividend is concerned, we're already at a point where we're starting to enter a crisis, right? And the reason being that now in many countries, the working age population is the highest it has ever been, but then at the same time, birth rate started declining quite significantly already in the 70s. I'll give you the example of Kenya. We were at around 4.6%, and right now we're at about 2.1%, right? So all of those people that were born at that point in time have entered the labor force and so on. But the quality of that labor, because at the end of the day, what we're talking about here is growth, right? And yet we have very low productivity, right? Just some, a couple of statistics here that have contributed to this. When you look at the amount of money that is spent per student in high-income countries, that's approximately $8,500. In comparison, within a low-income country, it's $55. The two sets of people are then expected to compete, right? It's impossible. Second, when you look at issues around cognitive ability, and here I'm now talking about the health sector, we have very high rates of stunting, right? And that also is related. I mean, this is nutrition amongst pregnant mothers and so on and so forth. What you can only see visually is the stunting, but then that's also correlated with cognitive capacity, right? So those investments are also lagging behind in developing countries. And we already have this labor force where when you look at statistics around education, many times if you give someone a test, you'll find that their level of comprehension is similar to someone in a lower grade in primary school, right? So these people will start aging. Also, we don't have enough jobs, right? And here I mean specifically decent jobs. The rate at which those are created is far, far lower than the number of people coming into labor markets, right? So all of these, I wouldn't say that we're looking at a future problem. It's already upon us.
Yeah, I wanted to come back to the presentation Aaron gave at the beginning and to connect it with an article that the German magazine Der Spiegel had about a year ago. And they said that this debt distress could lead to the largest humanitarian crisis in the last decades. So 688 million people live in these low-income countries, and when those countries can't pay back their debt, that means the governments are not able to deliver basic services to the people. So we are not just talking about technical issues. And if we connect that with the fact that we are talking about 1% of total global debt, I would like to raise this question of forgiveness or cancellation of debt again. I mean, if you just cancel 20%, we are talking about 0.2% of total global debt. And on the other hand is this major potential humanitarian crisis. So wouldn't that be something that it's worth to consider at least? That's one thing. And what we haven't touched yet is the second point, these austerity measures that are imposed by World Bank mainly. And I'm living in Kenya, and last year the Gen Z protests, they targeted the government first, but second they targeted IMF and World Bank, because people are no longer ready to accept these austerity measures. And it's like a second price. There's not just the interest rate, but there are these austerity measures and somebody pays the price for them. And it's the people in these low-income countries who are already struggling every day. So I would be interested in your view on these austerity measures.
On the first point about Africa's debt, yeah, I mean, Africa's debt could be sorted out without significant systemic impact. There are a couple of things here. The one is really the institutions themselves and the willingness to set precedents. If you were just to do willy-nilly cancellation, I'll leave the moral dimension out. There is that. There is also the concern around so there's the country concern, there's the bilateral concerns around that, and I think the Paris Club in particular has done quite a bit in that regard. So the problem isn't necessarily the Paris Club. The problem is the other public creditors, and in the specific case of China, it's also how you designate public institutions, public finance institutions. So you mentioned, I think, the Chinese Development Bank. China does not regard Chinese Development Bank or China Development Bank as a public institution that then would qualify as to grant debt relief or debt cancellation. They also have an issue with the fact that the IFIs, the World Bank, is regarded as the superior, the uber creditor. Okay, and the fact that they are not part of the negotiations for any of this in the common framework. So that's another dimension. And then you have the private creditors. And the private creditors, of course, there is a strong case to make that there should be parallel negotiations with all of these categories of creditors when countries enter the common framework and so on. So that it's not that, well, the one goes first, it's not sequential, because the private creditors are always the ones who come out better, in fact. But there's also the consideration, when you think about private creditors, that you're also dealing here with people's pensions. People who've invested in many of these funds that, are then loaning money out. Actually, it's their pensions. So there's another consideration. So even though the amount is very small and can be dealt with sort of without real risk to the system, I think there are also many forces at play here and many competing interests that make it very difficult. Certainly for cancellation, perhaps more for some sort of haircut or perhaps some extension of maturities and so on. On the austerity, I mean, this is a big thing because the IMF and the World Bank really need to rethink the way in which, because it's gone through many permutations, the so-called Washington consensus has evolved, and the extent to which the Washington consensus and the structural adjustment programs of the 80s and 90s and the early 2000s actually are part of the problem now. Because austerity has been really about attacking state capacity. So I take your point about needing to cut resources, say, in the South African public sector, because I think we're over-bloated and we're not delivering. If we've got 800 billion rands worth of salaries that we're paying in the public sector, and yet we still have all of these non-deliveries in social services, that's a problem. But you also need a capable state. We've heard the importance of governance and so on. And so I'm hoping that because the IMF and the World Bank are in this process of reflection, the Bretton Woods at 80 initiative and so on, that some of these actually need to be factored in and need to be changed in the way in which they apply conditionalities. The one dimension of it in the case of the debt issue people have been putting on the table is to say countries are too scared to approach the IMF but before they actually need help, but maybe they should be able to do that confidentially so that they can actually be helped before it gets to the point where you have to take out an IMF program, etc., etc. The point I want to make lastly is that really we're in a completely different global economic, geopolitical landscape, and a lot of the paradigms that we thought worked in the past, we need to rethink.
Right, okay.
So maybe just one quick point. I'd also, as far as austerity is concerned, I'd also just like to draw attention to value for money as well. We have across the board, right? You look at portfolios, investment portfolios, and you look at the performance of those portfolios, and in many cases, probably more than half the projects are underperforming or are not moving, right? So governments also, I think, need to be very serious about ensuring that they're extracting value for money, because even countries that are under significant risk of debt distress are still originating new projects while they're not fulfilling their obligations on existing projects.
I will speak a little bit in French. Pour la postérité, c'est pour rappeler un peu l'histoire de ces dettes. Après, je vais résumer un peu en 2 minutes en anglais. L'histoire de la dette de nos pays est celle d'une formidable ponction opérée par la finance internationale sur les peuples les plus démunis. Une ponction Une ponction programmée pour être indéfinie grâce à un mécanisme infernal de reproduction de la dette à une échelle de plus en plus vaste. Mécanisme que l'on ne pourra briser que par l'annulation de la dette. La dette doit être examinée historiquement, tout en faisant ressortir ses aspects juridiques, notamment son fondement au sens du droit international positif, qui considère déjà qu'elle est illégitime. La dette des pays en développement résulte en partie de la prise en charge indue des dettes des États colonisateurs imposées par ceux-ci à nos jeunes États au moment de leur accession à la souveraineté internationale. En effet, dès 1960, la dette publique extérieure de nos pays atteignent 59 milliards de dollars des États-Unis, grevée d'un taux d'intérêt de 14% unilatéralement fixé. Cette dette a rapidement augmenté. Les nouveaux débiteurs, avant même d'avoir le temps d'organiser et de démarrer leur économie, portaient déjà le lourd fardeau de la dette. Par exemple, la commission Lester-Pearson avait estimé qu'en 1977, déjà, la dette, c'est-à-dire le remboursement annuel du principal et le paiement des intérêts, dépassait à lui seul le montant brut des nouveaux prêts dans une proportion de 20% en Afrique et 30% en Amérique latine. I just would like to say that, in English, I would like to say that the depths of our countries result in part from the Hindu assumption of the depths of colonizing states, imposed by the latter on young states at the time of their accession to international sovereignty. Indeed, by 1996, the external public debt of these countries, our countries, reached $59 billion. I would like just to ask, why not to demand for the cancellation of this debt? Because I think that this debt is not our. It's not just not our debt. That was before our states. So I put this on the table. Maybe you don't have time to discuss about that, because I would like to address.
Would anyone like to?
Thank you very much.
I mean, I think the arguments regarding the cancellation of debt and debt relief, in relation to parts of Africa which have inherited a lot of debt are important to have. But one thing that I want to just speak on, it's a pity that they aren't here, because there's a lot of also criticism of sort of the World Bank and the IMF, that these like boogeyman institutions go in and structural adjustment, and I work with these people all the time, and I can tell you that they are generally invested in the development of the countries that they are trying to help. You can believe me or not, but generally they are in many cases. And do they get it right all the time? No, but they are trying to use debt and the provision of debt in order for countries to drive growth. It's not the idea is not to trap people into a cycle of debt. That is not the basis on which neither the IMF nor the World Bank in particular operate. That's not their intention. And I think that's worth also engaging on, because very quickly they are painted as these the Bretton Woods institutions that serve particular interests and are trying to trap developing countries in a cycle of debt. But maybe that was true many years ago, many decades ago, but now it is not. And I think there's a general frustration as well that is directed at countries which are accessing public debt but are not using it. They are failing to deliver on the programs that they need to invest. They're failing to develop infrastructure that enables economic growth. And when that doesn't happen, they ask about debt cancellation, because they themselves have failed to use that debt in order to grow their economies. And that's another discussion we can have as well. But I take a different view, which is that there's a role for debt cancellation, but there's also a role for debt responsibility. Just as you as a person, when you access debt, if you misuse it, you need to be held accountable for it. You don't get to go to the bank and say, please cancel this debt.
What can they put on the table to get African countries out of this morass? We have a spectacular example with Mozambique, the 2 billion IMF debt. What is the framework that has a recourse for these countries, where I totally disagree with you, sir, on that point, when IMF deliberately went against all guardrails to give Mozambique $2 billion, and it was all opaque delivery, so until it had to come to the parliament. What concrete steps can we take? Thanks.
I think what's more important when we are talking about austerity, I was thinking of a township resident with a 2-plate cooker, and someone preaches austerity. I don't know whether I said something there. Yeah, context is important. I look at Zimbabwe, 1980 when it won independence, 1 in 24 people were working in the public sector. As I'm talking to you now, it's 1 in 6 people. So when you preach austerity, what does it mean? Because already there's an underlying current of deindustrialization, isn't it? So I think that one I'm not going to spend time on it, but I want to contextualize austerity. G20, I think what's more important is also to ask ourselves what it means also when you say G20. Is this something we have to over-celebrate? If you ask Pretoria government and you go to Washington and talk about G20, does it mean the same thing? Before G20, there was BRICS. Before BRICS, there was this. We already have even regional economic communities, your SADC, your COMESA, your what. I'm not a fan of maybe looking at just institutional framework and maybe waxing lyrical about their existence just for the sake of it. I personally don't think so. So I don't think the issue is on G20. Charity begins at home, isn't it? So before you worry about, wasn't it G20, whether it's G7 up to G20, you have to worry about what's closer now. Because the inequality, the poverty levels in South Africa as it shares the G20, it should worry more than worrying about G20, where every country around it, it's a high-income country. So I think it's important to know how we handle it. And I don't think South Africa will lose sleep or over-celebrate sharing that, given how the world is closed. The Trump effect, where he's saying it's make America great again, or it's America first. I think I was talking to colleagues on even EU. Most countries look at how they are investing more on their defense budgets. They're saying it's not safe out there. With the whole never-ending standoff between Ukraine and Russia, who is safe? Who is the next aggressor to who? So I think unfortunately, most economies are inward-looking to the extent that when you look at G20 or BRICS, it's an African story. The low-income countries we are talking about here, it's African economies mostly. And some isolated cases, obviously, from Latin America, one would say. We have charity begins at home. But when you talk about debt trap, surely can we lose sleep over a debt of 10 billion when our potential exports are 13 billion over the same time period? It's quality of governance we are dealing with here. So maybe that's why I said you can't deliberate on debt and try to exonerate the governance and also the geopolitics. Obviously, it's important because countries can also be on sanctions, countries can also be on what? All those are realities. I don't think anyone will sit and discuss data alone. As I conclude, Mr. Moderator, statistics at one point from open source, the argument was USA, with its 300 million people, the rate at which USA spends, the spending pattern of USA, if it was to be shared by all countries in the world, the resources of the world would be depleted by 2060. So when you're talking of austerity or safety nets, the best safety net is for Africa to look at itself and say, with these commodities of lithium, of gold, how do we build the value chains upwards without exporting raw materials? The trade patterns we have at the moment is so predictable that debt can only increase. Look at our challenges in terms of mobilizing resources domestically. 80% of our export receipts is primary raw materials. It's sad. So debt trap, it's a function of quality of governance. It's a function of the geopolitics, some of the exogenous factors we can't control, obviously. But if Trump believes it's America first, Africa, we should look at it as Africa. Our small economy is some 60 billion GDP, 20 billion. I don't think we need to look at them. We should look at it as Africa. There's a CFTA now. Let's take advantage and look at it that way. Thank you, Mr. Minister.
We've had a wide-ranging discussion and different perspectives, but I think when we talk about debt, All of these issues are actually part of the puzzle. So absolutely, you cannot just look at the external environment when we talk about debt traps. You have to very much look at governance. You have to look at where you can make cost cuts. But at the same time, you should not be eroding the ability of the state to deliver socioeconomic services. So and I think the panel has done well to paint that picture. The second point I want to make is that if we're talking about sustainability and economic growth, it is about transforming our economies. It's about, in the case of some economies, reindustrializing. In the case of others, it is industrializing. If you're wanting to build up your ability to trade, your ability to create jobs, because that's the other thing, we're getting 12 million new young people into the job market across the continent every year, and we're not absorbing them. Okay, we've got to transform our economies, and in the case of South Africa, we've got to build up. We've got to sort out all the bottlenecks that we have, and we have to sort out our education system. And in the case of some countries, you've already alluded it, and most certainly in the case of South Africa, we're actually we're departing from our demographic dividend, because the birth rate is starting to drop. So that's the third point. And then just on infrastructure weaknesses and things like that, I think that goes back to the issue of accountability and transparency. So I remember being in Kenya a few years ago when the Chinese infrastructure projects were going in full swing, and they had tarred the road from the airport to Nairobi or whatever, and there were parts of the road that were breaking up. And the conversation then was from Kenyans in civil society and whatever is, the specs were not published, the specs were under what they should have been, and this is why it's happening. But none of that was actually published. And so the issue of transparency, in the same way that we're expecting transparency in debt, there should be much greater transparency in all of these. And certainly making use of legislation like public access to information, et cetera, where these exist in many African countries is important. But that also talks to the important role that civil society more broadly can play in that regard.
Structurally speaking, first and foremost, increasing Africa's, and I think also just generally across developing countries, the share of global trade has been declining, so exports have been declining. That needs to change. Increasing productivity as well, so in terms of growing human capital, I think we've already talked about that. That's the foundation of growth. So those two factors sort of playing in. But in order to do so, debt is not bad, right? But the instruments as they're currently structured does not allow long-term investments to be made sustainably. Shock soccer, and then everything sort of goes to a mess, right? So over the short term, thinking about how to restructure those instruments to have inbuilt sustainability so that we don't have to talk about social safety nets and whatnot, right? Everything should work in such a way that long-term investments, which we know will yield dividends, right? This is clear. There are lots of studies that show, and I'll just give a very, very short example. Nutrition tablets to pregnant women, for example, dealing with cases like trachoma that affects so many countries. Ethiopia, I think, as the largest case. $1 of investment gives you $37 in return, for example, right? Minimum, right? These are low-risk investments, right? But we need the instruments to allow us to realize those gains.
Thank you very much.
If I just want to leave one message, I think, for this group, from my personal experience, being in a country that has defaulted, default is very expensive, very costly. So if you can act early, negotiate in advance. Because once you come to the point of you're against the wall, you become, you have to just take what is given to you. It's very difficult to negotiate. So the first thing is it's extremely costly. You have loss of market access, macroeconomic instability, even financial sector disruptions, and I think we talked about that, and severe legal risks. And the second thing is, once you have unilaterally defaulted, basically the creditors will come in and say, okay, we will negotiate, but on their terms. And the terms is basically, they want to see you bear some of the pain of adjustment. And that's where the austerity comes in, unfortunately. And austerity affects the most vulnerable populations. Households that are low income because they can't hedge against inflation. They lose their real incomes. People with fixed incomes lose their real incomes. So malnutrition, health outcomes are poor. And in fact, in Sri Lanka, even education outcomes, because we were kind of a poster child for human development in disease. With very good health, education outcomes, and poverty. We had brought down poverty to like 6% of the population. After the default, it went up to 1/4, so 25% of the population, or nearly 30%, sorry, went under the poverty line. So you can imagine the huge cost that default, the default had on the populations. So what I want to say is negotiations are vital, and I also have to agree that the lack of governance and poor decision making is kind of the root cause of this economic crisis. And creditors know that your fiscal mismanagement was one of the reasons why you went into the crisis. So they'll insist on these austerity measures. But I think when you're negotiating, and that's where I think the capacity within the country, particularly in your government, but also in civil society, to negotiate, because IMF kind of plays and I agree with you, they kind of play middleman, right? Because the creditors, you've got this very diverse group of creditors, they can't negotiate one-on-one. So the IMF is kind of the one that comes in between. But you need to be, you know the ground situation. You need to be able to negotiate strongly with the IMF in terms of what your population can bear and who really needs to be protected. And bring in those safety nets early. Governments very often, I think you mentioned that, much prefer to pay the external creditors rather than, service your people, because they want to quickly get back into market access, right? So civil society plays a huge role, and I think building the capacity of civil society and empowering civil society to act as that, the conduit in a sense, to protect the citizens, I think is extremely important. Because finally, you are using their resources, right? The taxes are being used to pay the creditors. So the civilians really need to be part of this whole process. So I think building that capacity and enabling and also building the institutions. I think the institutional framework is important. In Sri Lanka, the lack of institutions was one of the key reasons why we went into this whole crisis. There's a lot of opaqueness in terms of the whole, how these debts were being taken. The central bank was a huge financer of the debt, which means that the parliament, parliament was bypassed, right? Because you can borrow from the central bank without having to go to parliament. So we brought in, under this whole debt, the negotiations, or this whole renegotiations, we brought in several frameworks have been brought in. So the Central Bank Act, which precludes the government from borrowing from the central bank, and also the Public Finance Management Act, which makes some strong recommendations or not recommendations, they're mandated to publish debt, and that's not just the government debt, but public debt, because SOE debt was kind of also hidden and not brought into the picture. And when you bring all that in, it suddenly ballooned. So ensuring that all debt is being they're transparent about all that is taken by the government, I think is extremely important to ensure that governments are held accountable. And I think for that, I think civil society did a huge job, because Sri Lanka was one of the first countries in Asia that had the governance diagnostic done. And it brought out a huge, it opened a can of worms of what was, being hidden within government. So I think these are some of the recommendations or lessons that we have learned, and I hope that will give you some ideas of what to do. Thank you.
John, I'll let you close the session.
Thank you. If you're a person or you're government, it doesn't matter. The same principles apply. There were some great recommendations in the paper that Aaron made of, currencies and the value in which the debt is quantified. These things are important. But I think also fundamentally, if you are accessing debt, you need to access it in relation to projects that you know are going to generate returns, and that you've done the right forecasting so that you aren't going to get caught into the debt trap. Because you have to pay it back. That is the basis. If you don't do that, you won't get more, and it creates a vicious cycle. So that's broadly on debt. Specifically on South Africa, to close, I think South Africa is going to have a tough time in the G20 for the rest of the year. I think we need to have a real think about our foreign policy, where we align, and where we want to focus. I think the change in policy in the US has neutralized aspects of the opportunities that were available to us in the G20, and it's going to be very difficult for us to articulate an agenda there, which is not going to be overturned next year immediately by the US, and that's going to be a challenge. South Africa, in terms of debt and the country, what I can say is this, is that in National Treasury, there is a firm eye on the debt to GDP ratio, and there is a deep desire to stop it from going higher. There is a deep desire to do that. We are introducing fiscal anchors and fiscal rules in order to try and force a stop and flag when government spending is going to become unsustainable. And there are some green shoots about how these are very real discussions. You would have seen the entire fight about VAT, which forced an entire realignment in the way in which the budget was done. 3 budgets in the end were created, which speaks to a level of accountability and thinking in terms of how we're going to frame our fiscal policy going forward, and manage our government spending downwards. Interest rates are coming down, inflation is staying down. So the green shoots are there of potential progress. But we have to get the economy growing. We are kind of laying the foundation. But if you don't start building on it, it's just going to rust and go to hell. And I mentioned a few of those key sectors: transport, the ports, energy. If you want to talk about the South African economy, take those with you and talk about them to people. Talk about Transnet, talk about the Port Authority, talk about the need to open up our energy markets, the importance of the digital communication space as an energy driver. These are all things that are front and center in trying to kickstart the economy. Because if we can grow the economy, we can generate more revenue from taxes and service our debt and get our debt to GDP ratio down. And that's good for everyone, ideally. We don't want to borrow more, and we definitely don't want to have increased taxes. We want to grow our tax base. That is the ultimate goal. We don't want to squeeze everyone who's around this room for more money. And the government is thinking that way. I don't know, VAT, but there are many within the state that understand that what we're doing is not sustainable, and we need to really change course, and we are trying to pivot the government to change that course. So with that, I conclude. Thank you very much again to the organizers, and maybe just thanks on behalf of the panel for hosting us, and thank you, Joe.
Well, let me just add to that, to the esteemed panel, thank you for your insight, your energy and your intellect. I really do appreciate it. To all of you, thank you very much for coming as well. A lot of food for thought there. Please drive safely. Thank you.